Good morning, everyone. Welcome to our Phillip Securities morning call for 15th of February. Today we have a few stock counter updates, results from DBS, Manulife, and Landlease, and some business updates from Thaibev and Singtel, as well as MM2 Asia rights issue. And then we also have our SG weekly as usual. Hope you guys had a restful weekend, Chinese New Year. Happy Chinese New Year. So without further ado, let us begin. Okay. So first of all, we'll start with DBS results. It is for their fourth quarter and financial year 2020. Okay, so for DBS, we are upgrading our call from neutral to accumulate with a new target price of $29.50 from the previous $22.60. So the results, you can see the snippet is on the left-hand side, just the fourth quarter alone, because that's what we are more concerned with. The rest we already know previously. For the positive side, if you take a look, the fees and commissions are actually back to pre-COVID-19 levels. So you can see they actually grew 1% year-on-year, which was largely due to the fact that wealth management fees grew 21% year-on-year. And that was on the back of a very good fourth quarter 2019 wealth management fee already. And so this 21% increase in wealth management fees actually offset the weakness coming from investment banking and credit card fees. We all know that the past 1 year has been pretty bad for credit card and investment banking. However, when we move towards 2021, we feel that credit card fees and investment banking fees will go back to pre-COVID-19 levels. And for wealth management fees, it will still have quite a good runway for growth. So we have revised our forecast for fees and commissions to increase 12% in 2021. For the second positives, we see that actually their allowances for the entire financial year 2020, after taking into account the fourth quarter itself, has already reached the DBS's lower end of their 2-year credit cost guidance. So they were actually guiding for $3 to $5 billion of credit cost across 2020 and 2021. And by the first year, which is 2020, they already have $3.1 billion in allowances that they have catered for. And this the fourth quarter, although just the fourth quarter alone, we see that there was an uptick of 4% quarter on quarter in terms of the allowance. But we need to take note that 183 million of this allowance was actually due to the consolidation of the newly acquired Indian bank, Lakshmi Vilas Bank. And as a result, we see their GP reserves actually hit 4.31 billion. So, and this is 42% in excess of MAS's requirement. So, in what we feel is that actually their total allowances should be sufficient to tide through both 2020 and 2021. So 2021 will just be, instead of a $2 billion credit cost guidance, it should be coming at about $1 billion to bring the 2-year total credit cost to $4 billion. And this is the $1 billion allowances is just on a slightly higher end on a normal credit cycle before COVID-19 situation. And a lot of the bad debt, if it actually does come in, they can actually take it out from their GP and go into SP. So this will not have any impact on their bottom line, if you take a look at that. Yep. However, in terms of negatives, I think we all know that there's a persistent low interest rate environment. So NIM was actually further compressed by 4 basis points quarter on quarter. So it fell from 1.53% to 1.49%. However, we saw that net interest income only fell by 2% on this margin compression. So this was actually because they had a modest loan growth of 4% year on year. So this helped to dampen the impact of the lower interest rates, low interest rate environment. The bank actually guided for net interest margins to come in at about 1.45 to 1.50%. And this was on the back of exit NIM of 1.48% as of end of 2020. For us, we have guided for about, we are forecasting about 1.46%, so slightly lower, because at the current low interest rate environment, what the bank can do is that, with all the cheap funding conditions, they can actually engage in some lower margins businesses such as interbank loans. So what these loans, their margins on these loans is actually very low, maybe less than 1%. But because it still adds on to their income, it will help to stave off some of the pressure in terms of the income. But when it comes to NIM, you might see further compressed by a little bit due to it being a lower margins side of the business. In terms of outlook, I think the first good sign is that we kind of know how the loan moratorium is going to play out, and it is going to play out positively. Loans under moratorium as of I think as of last week when they announced their results, it actually fell to $4.5 billion. So this is just about 1.2% of their loan book. Previously in the third quarter when they announced, I think loans under moratorium was about close to 20 billion. Now it's about 4.5 billion, so it's slashed by quite a huge amount. And the remainder of this 4.5 billion is expected to expire by the second quarter of 2021. So across April, May, June kind of period. So we will know more as we by the second half of the year. And on all those loans that have actually exited the moratorium, what we saw is that there have been very low delinquencies. So people have been able to pay back their interest, and this will help. This will of course help to mitigate the asset quality deterioration. So as a result, we actually halved our credit cost forecast, like I mentioned previously. Initially, we expected first year to be 3 billion, second year to be 2 billion. Now the second year, we are cutting it from 2 billion to 1 billion, which is 2021. And then secondly, we also see that they have a lot of pipeline for growth. I think it has been a busy quarter in the fourth quarter last year for DBS. Their Indian bank consolidation was actually quite well managed in a sense that they actually took on quite a bit of they recorded more NPAs so that people erase the doubts of any things going bad from the Indian bank. And so how they clean up the books first now, then it actually helps to expand their India footprint into the South Indian region, which is what they were lacking in previously. And also they have expanded into the securities business in China and Singapore. So in China, they actually set up a joint venture with the locals, and they will be entering the securities business in China itself. For Singapore, it is engaging with SGX to open up their digital exchange. And I think currently, of course, the impact to the business is very small. But as we move along, and as the global equity capital markets conditions improve, this will help to see some contribution from these new businesses. So this is something that is good for them. And as a result, we are upgrading our neutral call to accumulate call with a revised target price of $29.50. We actually revised our 2021 earnings by 6% upwards on the lower credit costs, which offset the weakness that we actually taken in for the net interest income. So we lowered our cost of equity assumptions due to the better risk environment currently, and we pegged our target price to 1.31 times of our 2021 price to book value. And with that, I'll hand the time over to Natalie, who will be talking about Manulife results.
Thank you, Wee Kwang. So I'll be talking about Manulife's full year 2020 results. Next slide, please. Okay, so starting off with the table on the left, we'll go through Manulife's results. Gross profit for the full year actually grew by 9.3%. This was due to the full year contributions from Capital and Centrepoint, which were acquired in April 2019 and October 2019. So this was partially offset by lower occupancies in Michelson and Peachtree, as well as lower car park income. So for the positives, rental collection improved from 94 to 97% in 4Q20, and rental collections would have been 99% after writing back $1.8 million in credit losses. So during the year end, when the books closed, Manulife actually recorded $3.6 million in credit losses. Basically, they wrote off some bad debts. However, after the books closed, just a few weeks ago, they actually managed to get a tenant to agree to repay the $1.8 million in arrears, basically. Yeah, so this would have brought the collections back up to 99%. Apart from that, Manulife also executed 279,000 square feet of leases in FY20, and this accounted for 5.9% of NLA. So some of these leases were actually signed by traditional office users, such as those from legal, real estate, information, and finance and insurance sectors. And in terms of new leases, renewals and expansions, the bulk of it came from renewals at about 60%. New leases formed about 56% of the leases signed, and expansions formed about 6%. So moving to the negatives, the negative is, of course, MPI fell, and this was due to low occupancy from some non-renewals. I'll show you guys the table later based on how each of the assets have performed in terms of occupancy and MPI. So the second negative is that so just to touch a bit on the car park income. So car park income on a normalized basis actually contributes about 7% of revenue, and of course we know that some of the states were under lockdown in the US, and also there was remote working, so that actually reduced the amount of people that were moving around, and also affected the parking spaces as they also service the patrons of surrounding entertainment venues. So that's why car park income was down by about 25%. So in terms of reversions, portfolio reversions were flat at 0.1%. So actually in the half year mark, we were positive about 7.8%. Yeah. However, due to one lease that was marked to market, this was the lease at Centrepoint, this dragged down the portfolio reversions to 0.1%. So excluding this one lease, the reversions would have been 4.7%. So what happened with this lease was that the tenant has been in the building for a long time. So because of the long lease and the 2% rental step-ups every year, so the in-place rent has actually overran the market rent. So that resulted in a mark-to-market back down when the lease was renewed. Yeah, all right. Next slide, please. So now moving on to the outlook. So this is the table on the left. This is the one I was saying about how the assets, the individual buildings have performed in terms of MPI, occupancy, and valuation. So we can see that MPI, the darker shaded squares are the one which suffered the most impact. So like Michelson, Peachtree, as well as Plaza. Yeah. Okay. So moving on to outlook. So softer leasing is expected in the near term as tenants continue to opt or renew on shorter lease terms, and lease incentives as well as rent-free expectations have similarly increased. So FY20 expiries are low at about 5.2% of GRI. Apart from that, even though we look at Manulife share price and we notice that actually the share price has not really moved much. However, we think this is not really justified. Okay, so according to JLL, we see that subletting in the cities that Manulife operates in is significantly lower at 6.4% to 21%. So this is in comparison to gateway cities of San Francisco, Seattle, New York, where subletting actually ranges about 28 to 30%, right? Okay, and in fact, right, subletting within Manulife's own properties is even lower, is at 4.8%. Yeah. So Manulife also outperformed the market in terms of market occupancy. So average market vacancy was at 17% at year end. So this is in comparison to Manulife's portfolio vacancy, which is only at 6.6%. So the top 5 tenants for Manulife: legal, finance and insurance, retail trade, real estate, and information. These 5 top trades actually contribute the most to Manulife's GRI, and unemployment rates in these sectors actually range from 2.8% to 5.9%, and this is below the national average of 6.7%. So all things considered, I think Manulife has been doing the portfolio. The tenants are much more resilient than the broader market. Yeah, so I think that Manulife actually, the share price has been under pressure because of what is in the market and not really what or rather the news that is in the market, not really what is happening within their own portfolios. So apart from that, Manulife is also eyeing tenants in new economy sectors and business parks. So the kind of tenants that they hope to acquire are those, they're in healthcare, life sciences, technology, as well as new and knowledge industries. And these kind of tenants actually tend towards business park kind of assets. So they are trying to, capture the type of tenants that are in future-centric sectors, and therefore they are chasing after these tenants and not so much the kind of building, the kind of like grade A office asset that they must have in their portfolio. So in that sense, we can expect that the next acquisitions, they are actually going to target business parks, low-rise business parks, about 2 to 3 stories, in suburban markets. So that our DDM has been shaved from 0.2% to 0.2 cents to our TP has been shaved from 92 cents to 84 cents. However, we still maintain our buy. Our FY21 and 24 DPUs have been lowered by about 10 to 12%. This is due to the leasing weakness. However, all that considered, we are still forecasting an FY21 DPU of 8.3%. So that's all for me. I'll pass the time on now to Jie-Hui.
Thanks, Ned. Okay, now we're moving on to Landlease Global Commercial REIT's full year results. Next, please. Okay, so starting with the positives, revenue fell largely in line with expectations, while MPI and DI exceeded estimates. This is due to better performance from the 3 asset, as well as higher revenue contribution from Sky Complex due to euro appreciation against the Singapore dollar. Secondly, we see improving sales momentum and as tenant sales and footfall improved by 20% and 12% quarter-on-quarter respectively. Operationally, 3 actually improved in occupancy as well, from 96% to 99% after signing new leases from experiential and F&B tenants. The last positive is the valuation upside that can be expected from Sky Complex, attributable to the developments around its district. So if you look at the picture on your right, on your bottom right, the district where Sky Complex is located in, MSG for short, this has 2 main areas. So the southern zone where Sky Complex is located will become the new CBD of Milan, while the northern zone will become a smart urban park. So this urban park will actually have an arena to host the Winter Olympics in 2026. And in addition, this area will see improvements in infrastructure. So a new metro line connecting the district to the airport will be built. And all in all, we are expecting these developments to enhance the value of the area. So yeah, we are expecting at least a 3% upside to valuation for the property. Next, please. Okay, so in terms of the negatives, we will likely see slow rent recovery in the near term due to slower demand or softer demand for retail space. To increase occupancy within 3 and 3, LV has provided several tenants with bigger variable components. But fortunately, the impact of this is mitigated by greater revenue from Sky Complex. As such, the variable component remain at about 3% of the portfolio's overall gross rental income, which is similar to pre-COVID levels. For the outlook, as mentioned, in the shorter term, we are looking at a slower rent recovery. But as the government plans to vaccinate most of the residents by end 2021, we believe that shopper and visitor confidence will be bolstered in the medium term. Stable contributions from Sky Complex are also expected to mitigate COVID-19 risks. Due to MSG's urban development, we are expecting 90,000 square meters of new office supply to come on stream from 2 projects over the next 2 years. The good thing is, one of the projects have already been 80% pre-let, and given that the lease at Sky Complex will only expire in 2032, Sky Complex income stream is actually expected to be very resilient. In conclusion, we maintain accumulate with a higher DDM target price of 82 cents from 78 cents previously. We raised gross MPI margins to reflect better 3 and 3 operations and included a rent step up for Sky Complex for FY22. As a result, FY21 and 22 DPUs were lifted by 8% and 5% respectively. And currently, based on the last price, it translates to a 6.1% FY20E dividend yield for potential upside of 10.9% in total. This is all from me. I'll pass my time on to Paul for Thaibev.
Thanks, Jie-Hui. So we'll run through Thaibev's first quarter 21 update. These are the results. There was no analyst briefing. I think the key highlight, as the title suggests, is the spirits division and the cost savings. But anyway, let's go through. If you look at the table on the left, The key business segment, which is the spirits, the one that is highlighted in the red box, you can see that because that accounts for almost 85% of net profit. So that was resilient. The volume was up 0.3 and revenue was up. The other key thing to watch was the operating profit at the beer segment, the other red box. You can see that the beer business, the profit jumped 51%. This is very curious thing considering the revenue. If you look back up again, the revenue line, you can see that the beer division revenue is down 9% and the volume is down 11%. I think the point we wanted to make was just that they did a major, they did major cost cuts. That's why they managed to grow the earnings so strongly. I guess no surprise that they're also trying to do an IPO, I guess. Okay, if you go back to the points, in terms of the positives, like we mentioned, the spirits division was resilient with the growth of 0.3. I think why spirits is doing better is that the spirits is consumed off trade. Basically, they're consumed at home, whereas those that alcohol consumed, in entertainment or retail channels, like beer, you can see the volumes for their beer business was down 6%. The other thing was the positive was the aggressive, like we mentioned, the beer business, the aggressive cost cuts. So although they took down the group cost was down 10%, but a lot of it came from the beer. So the beer costs, they actually cut almost 1.3 billion of Thai baht of cost. So you can see that all the growth actually came from cost cuts, which was down 26%. In terms of the negatives that we got from the results was Sabeco. As you know, Sabeco is their Vietnam beer subsidiary. So that was another weak quarter. I mean, the volumes were down quite a huge, 11%. And there were a few reasons. The Decree 100, just to refresh everyone, Decree 100 was the drink driving rule, the strict enforcement of drink driving in Vietnam in early 2020. So they're feeling the effects of that. That actually caused a big that actually curtailed a lot of alcohol consumption. Surprisingly, I guess. And the other thing that affected results was the typhoon in October and the late tax, like their so-called New Year celebration. So because it was pushed, it was a bit later. So year on year, you get a bit of impact on year-on-year comparison. So the second quarter or the March quarter, you should get stronger results because the New Year was some kind of pushed forward by 10 days. The other negative was the plunge in Fraser's property earnings. If you look back on the table on the left again, the second last line, you can see that because Fraser's and F&N are associates, they combine both, and then you can see there's a 60% drop in associates. Bulk of it came from Fraser's property. The problem we have was that Fraser's property did not disclose their numbers. So we can only infer that some of the reasons why the results was down was the lower property development, no weakness in hospitality as usual, and retail operation. In terms of outlook, there are two points we just wanted to highlight. I think the first thing is, of course, you should expect gradual recovery in alcohol consumption. And then Sabeco, the volume should rebound because the Decree 100 impact will wane off. The second thing to watch is, of course, the listing of BeerCo. Like we highlighted, if we assume 30 times PE and 20% sales of this sale of the stake, the impact is very minimal. I think less than maybe around 1%. Of course, you get interest savings of 3%, but then 1/3 of it will be used to subscribe for the Fraser's property. As we mentioned, Thaibev has a 28% or 22. Sorry, 28% stake. I think. Just slip my mind, but they had there's an associate stake in Fraser's property. So as a result, they have to fork out almost 360 million to subscribe for the rights issue. Then the other thing was that because there's a dilution in the beer, we assume 20%. So net, the listing of BeerCo has a very minimal impact on Thaibev's PATMI profit. We downgrading it from buy to accumulate, and it's purely due to just the share price performance. There's really no change in the outlook from the last quarter to this quarter. So we're just maintaining everything. Our target price is 18 times PE, and we're just using the 5-year average to kind of get our target price for Thaibev. Next slide. Okay, the next is Singtel's results. They also did a third quarter 2 update. There's no analyst briefing again, and they just sent out an update, not a full set of results, but just an update of what happened in the December quarter. So there were some bright spots in Singtel's results. Next slide. Okay, in terms of the positives, I think the first thing is the enterprise business. Now, enterprise is actually the NCS, is like your typical IT service company. So that did well. I think that was resilient in a sense. It didn't grow, but it was resilient. You can see from the table on the left, it was down 1%. The thing for us was that they mentioned in the third quarter that NCS actually alone got 800 million of bookings. Whereas, in the first half, the bookings for the whole enterprise business was only 755. So you can see there's a big improvement in the bookings for enterprise business. The other positive was the Australian consumer business. The revenue was quite stable. You can see on the left the revenue was only down about 3%. But if you take out the NBN is a compensation that they're getting from the Australian government. So that kind of makes all the numbers look very weird, because some will be before NBN. So it can be quite confusing because of the whole NBN. But if you strip that out, it's actually up 5%. And there was also the currency impact of 5%. So the consumer was actually flat. I know it's very confusing, because you have to take account of the NBN, you take account of the Australian FX was actually up almost 5%. Okay, but anyway, for us, we saw it as a positive because the mobile business, the ARPU actually managed to rise in Australian dollars 3%. So, which is positive. I mean, you can raise mobile prices. And then the other thing is, of course, the turnaround in Bharti, their Indian associate. So the net loss, you can see from the table on the left, the third last column, the losses dropped from 87 to 4 losses, a 95% drop. Okay, the negatives was, again, Singapore consumer. I think these are the same negatives that has been lingering on Singtel the last, I think, three quarters or 4 quarters. So the first one is the Singapore consumer. So the revenue contracted 11%, and that is mainly because the ARPU dropped 26%, and dropped because you lost the roaming revenue that we highlighted before. So if you compare earlier when we mentioned Australia, the ARPU, which is the selling price for mobile, went up 3%. But as for Singapore, you can see the contrast, the huge decline in 23%. The other thing is that the EBITDA for the Singapore business was down a huge, 22%. It would have been dropped 1/3 because they got some government support, the GSS. So if you take out the GSS, the drop will be even worse. The other negative is actually the Australian business. While the revenue was stable, but if you look at the EBITDA, it's actually down 20%, and in part it was down actually to even 29 if you take out the NBN in the EBIT, and in part because, like I think we mentioned again before, that they are running 2 broadband businesses. One broadband is using the Netlink equivalent providers. That means they're outsourcing it because the government had mandated that, and they're also running their own broadband. So they're just being burdened by their own on-net broadband costs. So it will take some time for that to clear. Okay, in terms of outlook, I think it's still the same issues. I think roaming loss, a high cost Australia, but it's more of a bit of balance now, because now there's some positive spots, which is the enterprise, the mobile, and then the Bharti. So in having said all this, and in the end, we're just going to keep our target price unchanged and earnings unchanged. Our valuation, if you break down the valuation, about 70 over cents only comes from the Singapore and Australia. The rest of it actually comes from the associates. But I mean, you can argue what kind of discount, but for us, we always just use a 20% discount, because if you keep on mark to market the listing to their listed associates like Bharti, then the target price will be like swinging every day. So we just keep it at 20% discount. So we kind of get a target price of 244. But do note that most of the value these days for Singtel comes from the listed associates, which is AIS, Bharti. For Telkomsel, we pack in some PE in there because it's not directly listed, because it's a subsidiary of the listed telecom in Indonesia. Okay, next slide. Okay, we're going to run through MM2 Asia's rights issue. Next slide. Okay, you'll be curious why we do. I mean, this is not even our deal. This is a UBKS deal, but we just wanted to share some interesting points. Okay, and MM2 announced under rights issue, a very simple one to calculate is a 1-for-1. So for every one share, you get one rights at 4.7 cents. It is underwritten by UB Kee Hand and also renounceable. Then the timeline, they still waiting. You still need to go through for the waiting for the circular or the document, so that but the EGM will likely be early March, and the shares should be listed mid-April, and they need to get it done because they need to pay off there's a medium-term note about 40 plus million, I believe. You can see under the purpose of 51 million. So the third price is 21. Okay. Other updates from MM2 is the IPO of the cinema business, the potential merger between their cinema business with Golden Village. The third point is that this quite important thing is that if they list they have a convertible bond on the cinema business, not MM2, the cinema business. If they do an IPO, then they can actually get rid of the debt. And then they also announced as a private equity interest. Okay, but anyway, there are two key things we just wanted to highlight. I think the first important one is they're going to de-gear. So if you look at the table on the left, so the net debt of MM2 is roughly about 253 million. Then once you get the rights issue, you will knock off 54 million of the debt. The other critical thing is that if they do an IPO in specie, if those who do not know, basically all shareholders of MM2 will just get free shares of the listing of the cinema business. Then you actually, the convertible bond that we mentioned will turn into equity. So you kind of de-gear one more time, that 47.9. And then, okay, this one is a bit harder to compute because they don't separately disclose. But if you assume half of that debt will go with the IPO, that means half of the debt, that 75.6 million, will be gone with the cinema. Then MM2's gearing after all the rights issue and the IPO of the cinema business, you're looking at the debt shrinking from 253 to 75. So that's the key point. I know it's a bit confusing, sorry, but basically the table is a summary. The other thing is, for us, was the interesting part, I guess, was the valuations. So post rights issue, that means after the rights issue is done and so forth, MM2's market cap will be roughly about 153 million. The stake in Unusual alone is worth about 130 million. And then the minority shareholder will also get a free cinema shares. And then in the end, you are just left with the core business and of course the other subsidiaries. But the core business in the past made about 11 to 20 million. I mean, we are not forecasting what they're going to make, but they did mention that for FY22, they're working on almost 20 titles. And in the past, their titles used to be 14 to 18. So they've got quite a good pipeline of titles to work on. So for us, we just thought that it looks interesting in terms of the valuation standpoint, although it's not rated, but this is just some commentary we wanted to make on MM2's rights issue. That there seems to be a bit of value in picking up the rights. Yeah. If you believe in the business, I mean, we all know what happened to MM2. They were performing well, then they started to fork out 200 million plus cash to buy the cinema business and then leverage themselves up into this state. Okay, I mean, next slide. We'll just do the usual Singapore Weekly. Next. Okay, in terms of the macro news that came out for Singapore, Singapore released their, not much, but in terms of the macro, we got our foreign reserves numbers, which was actually very strong. We have that's 370 US billion. It's a record high for Singapore. In a nutshell, just that there's a huge amount of liquidity in Singapore. Whether it goes to the equity market, I'm not sure, but it's one of those things. Being economists, you'd say a lot of data points, but whether is it relevant or not. So probably this is one of those times. But anyway, just to share that there's a lot of liquidity in Singapore. The other macro news was the property transactions. This is not from URA. I mean, I just took it from the newspaper. It came from Orange Tea, but the number they gave was 1606. So year on year is a 159 jump. It's much stronger than the December, but I guess the important thing was that this is the highest monthly transactions since July 18. And why July 18 is important? Because July 18 was that month where there was a mad rush to buy properties ahead of the increase in ABSD on 6 July. So this 1606 is actually a very big number because it's, and then considering that December was also another strong 1002. So the property market in terms of transactions is very vibrant. Of course, you get volatility. Sometimes if there's no launch in February because Chinese New Year, then the numbers will dip down. But it does show that there is a huge vibrancy in the property market. In terms of US news, not much, but Powell had a speech at the Economic Club. So just to remind everyone that what he said was not even thinking of withdrawing support. So basically, just to tell everyone that rates should remain low, and the Federal Reserve's plan is to only start to move rates in 2023. So, and then because what he thinks that the job market is still very, very weak, and the true jobless rate is 10%. And also the other thing was Yellen was going around telling everybody to go big, usual go big, basically just to go big on fiscal stimulus. Okay, the key data point from the US was, of course, CPI. I think now everyone is so worried about inflation, but so far the numbers are very benign. Core CPI, I think you can read it from there, 1.4 versus December. So actually trending down instead. Later, we'll just give you some Genting Singapore and IFAS, some commentary, because I know not everyone might get access to their results briefing. So we'll just share with you some of the key things that we think that they mentioned. In terms of our tactical view, we think the conditions for an equity rally remain. I think, like we said, the low interest rates, low inflation will remain, and then we're entering into a recovery phase led by the pandemic tapering down, and then there's a reopening, and at the same time, in the background, you're going to get a huge fiscal stimulus, at least in the US. I'm not sure about Singapore, got to wait on Tuesday, but at least we're getting a huge fiscal stimulus when there's a reopening and recovery underway. The bottom ones, the weeks ahead, I think you can see some of the events. Our budget is, of course, on Tuesday. And these are all our poems webinar. Feel free to sign up. Not everyone is on. I think we haven't got PopNext in yet, but I think the rest are all on poems. So if you do have the time, just feel free to sign up and listen, because there's no recording for all this. Next slide. Okay, again, this is, I guess, the good news. You can see that the pandemic globally is down and is falling 46% month on month. And this is even before mass vaccination. I mean, there's vaccination, but of course, it's not mass vaccination. So we should expect the cases to continue to contract. Next slide. In terms of Singapore, the cases are quite lumpy in Singapore. I think some days we got 2, got 3, then the last 3-4 days got 0. But in all, the COVID numbers is still out there, I guess, in a nutshell. And we have like 7 communicates in the past 1 week on average. Next slide. Okay, this one again is like those economists chart, a lot of data points, but I'm not sure what's the relevance to the equity market. But just for information, I think the blue line, as you can see, is the FX reserve in Singapore. It hit 370 billion. And the red line is just a trailing 12 months. It just shows you the net inflows. So in 2020, the net inflows up to December was 82 billion. Then if you look at January, the net inflows is 91 billion of money coming into the Singapore system. So you can see from the red line is like record high, everything record high. So there's like super huge amount of liquidity in Singapore. Next slide. Okay, I'll just quickly run through on the briefing that we had with Genting Singapore and IFAS. Okay, anyway, for Genting Singapore, in terms of the outlook, I think the key message they wanted to say was that Genting Singapore, until the borders reopen, is still reliant on a very small domestic market. And then they don't see much change in revenue, or if the financials will likely track second half. So, I mean, if I use that, and then if you assume the second half PATMI is the full year PATMI, you're looking about 370 million. It's just quite close to consensus. And then the PE right now for Genting is about 28 times. But do remember that they do not disclose how much government support they get. So a large part of the PATMI could actually be a lot of government grants, but we do not know because they do not disclose. The other thing that they mentioned in the briefing is that vaccination is important. I think their point of view is a bit different. Their view is that the vaccination is important to lower the risk of another circuit breaker. I think the biggest fear is if you get into a third wave or second wave in Singapore, and then there's another lockdown, and then all bets are off. So they're very worried of that. And of course, for them, vaccination will just kill off that tail risk of another lockdown. So that's why it's very important from their point of view. December was a good month because holidays, but then January, the things start to drop back again, the occupancy. Then they just wanted to highlight is that even though Singapore has open borders, so even if let's say a visitor from China, for instance, comes into Singapore and doesn't have any stay-home notice, the problem for the visitor is that when he goes back to China, for example, he could have a stay-home notice of 14 days. So basically, it's still very inconvenient for any visitors to come here to gamble because although you can walk into Singapore, but when you go back, you still get stuck in the stay-home notice. So so foreign visitation will still be very tough. And of course, Malaysia, one of their main markets is also trying to get the COVID numbers down. The other point is Resorts World number 2. They are going to they're going to spend another 4.5 billion to redesign. They need to redesign it because one thing they mentioned was that the super VIP will disappear. I think the comments came in line with what the Chinese government recently placed restrictions on their citizens gambling outside of China. So I think they're almost calling it illegal to gamble outside of China. Again, this China regulations still not particularly clear, but I think you can read it from all the media outlets that China has come up with a new law. They didn't mention which countries, but they just say outside of China. Of course, Macau is okay, but outside of China, it's almost like illegal to arrange gambling activities. Then in terms of the Japan, it's still RFP. They're looking for guidelines. I think that's you can read it for yourself. The last one for me is just on iFast. The results was good. It more than doubled the fourth quarter. But if you look at the PE now, you're talking about 80 times PE. Their assets under administration went up because of digital adoption, and they managed to help the FAs, and they're still sticking to 100 billion AUA under 2023. For those, just for interest, I think their comments on trailer fee is that it has been banned to payment from any product provider to the FAs in UK and Australia. They don't think it will happen in Singapore for the next few years, but they think that even if it happens, the people will adopt the platform faster. I'm not particularly clear how that works about it. The fourth point is just, the big hype now is about the eMPF contract they won. So just a reminder that they could not give financial details, but this contract was awarded to PCCW. iFast is not the equity partner. They will subcontract, PCCW will subcontract to them with a certain fee on an annual basis. They can't disclose a lot of the financial stuff, but the contribution to iFast will only happen in 2023 onwards, and it will be very material impact. I think the rest you can read at 2-year implementation so far. iFast is also submitting application for digital bank in Malaysia. The last point is, it's just that they have their own in-house advisory, and he just said that their FAs have, in terms of AUA per FA, is one of the highest in the industry because they focus on red bonds and so on. And it just, you can read it off on your own. Okay, I think that's the last slide for me. Next slide. Thanks everyone. I think we can move on to questions. Thank you.
Okay, I think I'll take one of the first questions regarding DBS first. There are still 5 legal cases pending on DBS LVB Messi merger. What is the downside risk to this, and has full provisions been made on the impact to DBS in the event LVS fails and the liability is borne by DBS? Okay, I went to check out on the legal cases. I think most of it is of the pending cases are from previous shareholders of Lakshmi Vilas Bank itself. I think them just saying that, the merged entity, they don't have a stake in the merged entity after DBS acquires them. I'm not sure how it will turn out. I'm not sure of the legal consequences, but what I do know is that in terms of the full provisions, so what DBS did was they injected sufficient capital and they took on sufficient allowances so that LVB on its own will reach the sufficient capital levels to operate according to the requirements by the Indian authorities. So that itself will remove potential bad loans or defaults by the bank itself. And also, I think, of course, over the next a few years, DBS is going to rationalize their footprint in India, which was brought about by LVB itself. So I think they acquired over 600 branches in India because of this merger, and they will definitely try to cut this down, because I think initially what they entered India on a very digital mode. Everything is all digital banking, and with this they get a lot of physical presence. But what they do notice is that having a physical presence itself does augment the digital banking business itself. So they need to see how this will help them grow the business in India, but they will not want to manage such a big number of branches that they have. And I think currently it is still in operating losses, but DBS feels that within 1 year, so by 2022 itself, they will be able to turn the business around, and LVB will be positive, will be above water by then. So I think the amount, and if you take a look at the total loan book by LVB is actually about $2 billion. I think you compare it to DBS, which is owning like $400 billion in loan book. It's just a small part of it, and a lot of it, if I'm not wrong, is like 40% of the loans there are gold-backed, secured by gold. So I think in terms of how safe the loans are, it is quite a lot of them has already been taken into account in their allowances. So it is nothing much to worry about at this point in time until we get any more information from them. I think this is something that shouldn't be a concern. And in terms of the legal consequences, that is another thing. We will need to see how it unfolds. But at the end of the day, I think they have already merged the entity. I think it is very hard for them to like reverse this entire decision right now. Yep, I hope this answers your question. I know it's a very long answer. Yep. Just let me see whether there are any more DBS questions. I'll try to take them. I think that's it from me for DBS. Maybe someone else, or for the bank side, maybe someone else can take the subsequent questions.
Oh, okay. Thanks. Let me just read out this question. Comfort Delgro, is there any point to continue hold for the long term? I do not see it being able to go past $2 with the existence of competition from Grab. Are there any other business units that could boost it up past the current levels, even after a recovery of tourists? Thanks for the question. It's obviously a very pertinent question. Again, firstly, as you know, our call on Comfort is just to buy on the recovery. In terms of what, I know your question is, after this recovery, what's next? The one to watch would be the MRT, the whole MRT arrangement, because there are talks of a major revamp of the whole, how the whole MRT is being done. Because right now they own the rolling stock, everything is taken on balance sheet. So they could move the MRT more into the bus model where they pay you a service and then it will become asset light. If that happens, then that will be good for Comfort. But again, these are obviously all very confidential discussions, but that could be one area that could help. If that is announced, there's some restructuring on the way the train system is done, then where Comfort become more asset light, that we will obviously be very very positive. But again, I do agree with you. I mean, the competing against Grab is obviously very tough. They got like the fleet out there, I don't know how many times more than you. So but that would be the one part. So that's why I know our target price was, if I'm not mistaken, about 180 something. It's not meant to be a long term. It's just a rebound from the recovery. It's more a recovery trade rather than a long term structural goal. But yeah, because you got this Grab in your background, they can lose millions of dollars and don't have to worry. Whereas if you ever go to the loss, all the shoulder scream at you here. Yeah. I'll move on to the next question. Those holding Thaibev, will we expect the share price to dip after the beer co-listing? Is it better to sell shares before the listing and buy back after listing if we expect the share price then recover? I think I do agree in the sense that maybe the market there was a bit of rally because of the Beerco thing. And there is some merit, I presume, but we're not into, for us, very hard for us to comment on very short-term trades until we get it wrong, right, the next few days. But I think if it does list, the shares might move up a little bit, my own view, because they managed to successfully de-gear, so it might move, then maybe they might correct later on. Mine's a bit more different. I think it might move a little bit when the IPO gets underway, because I think the unknown right now is what is the valuation. If the valuation is very high, if it's the worry, the unknown is if the valuation comes in, if they can't list it at very good valuation, then it might take a hit to Thaibev. Mine is 30 times PE, but I think they could hit it because mine is historical, and you just saw the results, right? The earnings is up 50%. They probably cut every bit. They probably cut their way into profitability just to show the good numbers and get a good listing. So the upside will be if they can do a listing that is, I don't know, 30, 40 times PE. Historical, then maybe forward is 20 times, because they will show very good numbers by cutting everything. So my thing is they might, and this is a tycoon, right? Obviously, he's a good chance he will probably squeeze a lot of investment bankers. So I think the IPO price could be maybe even higher than what we think. My own feel, I have no idea, but because they're such a huge conglomerate, they can push their way through for high valuation. My own view, I'm totally not very sure. I just run through another. What's your opinion on Jaffar Bumi Tamak? So sorry, we don't have a plantation analyst, so we're not very so can't commodities, and so we can't really help you on that part, because if you do Jaffar, it's not so simple it's not a simple thing to answer, because you have to look at the whole how chicken prices are trending in Indonesia, and we don't have that data point right now, so we can't really help you on that. Sorry. Next question: will 5G help in the bottom line of Singtel after the launch? I doubt it. I think even Singtel admits it themselves. There is no really killer app or killer use for. It's more like so the situation right now is 5G will of course be faster speed and lower latency, and then customers might pay extra for that. But the worry is that what if your competitor is also selling the same thing, right? If you're competing only on faster speed, lower latency, your competitor can also just offer cheaper price, and then you're back to square one again, and competing on faster speed, and so there's not much differentiation. So, and if there's no differentiation, then you're going to get another price war on 5G. So whatever lift in ARPU might be just kind of commoditized away. So 5G won't really help Singtel at this point in time, unless you find some really strong killer app, which so far no telco has mentioned, so I don't think there's any right now at the moment. The next question, hi Paul, based on presentation, MM2 REIT still worth subscribing? For us, officially it's non-rated, so do note that, but there is, MM2 share price used to trade 80 cents, so now it's 8 cents. There could be some value in there, but again, this is all on the assumption that they managed to list the cinema, and there's a good chance you can do that because you are doing in specie, right? So, and then you got already the number of shares, because it's all your existing shareholders, so you can hit the free float numbers and the shareholder spread. So if that happens, then that will be another catalyst for the MM2 share price. So these are some of the things that could help drive the rights. Again, non-rated, but I think there looks to be good value there, at least on paper at least. Next question, what is the reason for the downgrade, I guess, in the target price of UG? Okay, we downgraded UG. When we do a valuation for UG, ours is a relative valuation. So what we do is our valuation is based on how the industry is trending. So the last 3 months since our last report, the share prices of the gloves got hit, so they are down almost 30%. So as a result, we had to downgrade our valuations, and our valuations is based on FY22. So that's the main reason. We are doing a relative. We don't want to do DCF kind of, because it might be all over the place because it's so hard to focus. So we're doing more a relative valuation. So when the industry valuation comes off, then we have to downgrade it. Otherwise, if it's so expensive, everyone will just rather just buy Top Glove and so forth. I will just quickly answer one on Fraser's property. since it was an early question, sorry, I know it's at the very bottom. There was a question on. Okay, anyway, I'll just answer. Where can I watch the replay of this webinar? Our webinar is in YouTube under PhillipCapital. So all our previous webinars are there. The other question: what is the ex-rights date and rights trading? We think it could be early March. There's no date given, but the usual timelines are early March. And again, they need to do this deal. Everything should be completed by April because they need to pay off the MTM, I think, the medium term note. Okay, let me try. Okay, hi Paul. 2 webinars ago, the corporate results table, you showed the APTT reported results on 10 Feb. Has there been a delay as of this morning? I still did not find the earnings announcement. Okay, you know, when we give those tables, we are just pulling out from Bloomberg. And what Bloomberg does is that if there's no announcement, they are just using the previous few years, when they announced. So there's been no date. It has to be by next week, because by next week all the results will be out. But so far they're not given a date on when the results will be out. The next one, anyone cover credit bureau? We don't cover yet, I presume, but as you can see from my earlier slide, we're going to do a webinar with them. So hopefully you can sign up, and then you can actually just listen and ask questions yourself. So, you know, we do all these webinars is for all the attendees, so that if you don't believe us, never mind, you can actually just ask the question. You can ask the company yourself, so we can give you access to the corporates, and then you can just ask your own question directly to them. Okay, I think, can someone else take the others first on the... Oh, okay, let me just answer quickly this Phillip's property. Hi, can you comment on Phillip's property rights issue and the TA for this counter? Viren will do the TA. For the rights, I think the answer is pretty quite clear, because the rights issue is $1.18 and the share price now is 121. So the third price, that means the ex-rights price is 120. So you subscribe, don't subscribe, I don't think it will make much difference, because the share price now 121. So even if you don't subscribe, you're not going to lose much, because it will just drop back to 120. So yeah, I mean, if it's at this price, no reason to subscribe for now. But of course, the share price ex-rights in the announcement, they did mention that the NAV for the stock, for what it's worth, is I think 220 after the rights issue. But again, no, whether you go back to the NAV, I'm not sure. But this is just all the information I have, because we don't really cover this business property. Okay, I'll hand it off to the rest. Thanks.
Viren, you want to take some of the TA questions first?
There's one question. The recent webinar on UG Healthcare, where can I locate the record? We don't, there's no recording on the webinars we do with the listed companies. I think listed companies are quite sensitive, so they prefer not to have a recording. So that's why there's no recording for that. Yeah, sorry.
Okay, so I'll go through some of the technical questions, then I'll pass some of the question regarding CapitaLand to Natalie, if she's available. Excuse me. So just give me a moment.
Let me answer this while waiting. Will MM2 be able to raise the entire 54.65 million successfully from shareholders if the resolutions are passed? Yeah, they will raise, because even if nobody subscribed for it, although Melvin, the founder has subscribed, but because it's underwritten by UOB, so regardless, even if no shareholder subscribes, the thing will be taken up. I mean, the money will come in regardless, because it's really underwritten by UOB. Okay. Thanks.
Okay, thanks, Paul. So I'll answer a question by Alvin. So will the Valentine effect mentioned in the US markets webinar have a similar effect in Singapore and Hong Kong market? This one I will update later, because I think the Valentine quote unquote day effect I mentioned was in 2 webinars ago and last webinar. So I will update the one tomorrow, later on at 1 p.m. So do hop on. But if there's like consider a sell down, the effect, I think more or less it will affect the Singapore market, more or less. All right, but if you look at the STI, I think you look at the chart, I think we have we are short of reaching the resistance zone over here, between 3055 to 3127, to 3121, sorry. But the downside, I think, although it's like look like it's being supported at 2921, but the ascending channel over here, little ascending channel here, look more like a corrective in response to the bearish sell side over here. So if it do break down some more, I think the next support will be tested for SDR will be 27622 to 2799. Okay, so yeah, this I'm done. So next one is chart for Yoma, UG Healthcare, Top Glove, Wilma, MedTech. Wow, okay. I'll go to okay, so give me. So I think Yoma last week, I think the last webinar I mentioned that I'm still waiting for this. Despite this being the like engulfing piercing line candlestick, the upside wasn't that strong. You can see that there's some selling pressure back after last week. So I'm still waiting for price to actually have a steady rebound over here at 0.165. The reason is because I think this is a new the breakaway gap. This is a very strong gap down. So unless price really break above 0.221, then we will actually look to buy on the upside. But otherwise I'm still looking at 0.156 to 0.165. Then 817. So for UG, I think I issued a call that I'm looking to buy, like there's a buy stop at 0.750. Price rally, but if we looking at further correction, as right now, so you have three bullish end wave, like sub bullish end wave. Then one major one will complete one major one. Then we will look for a three wave down again. Likely support is 660, and then 625 is the likely support as well. Okay. Then due to time, I'll do the larger cap. I'll do Wilma, and then skip the rest. Wilma has actually today has already broke out of the what do you call it, the pennant. So expect one more test at $5.58 to confirm the upside. Okay, so target wise will be at $5.92. Okay, for Wilma. So done. Next one is UOB, OCBC, Sam Marine, and Maple Tree Industrial Trust. Okay, so I'll do OCBC first. Then I'll do all the three banks anyway. So the banks today, I think OCBC today has closed higher gap above. So it's like a window gap. It's just a common normal gap today because it fails to clear above the resistance at $10.74. Hence, I think I'm still remain neutral for this, for OCBC. Okay. And same thing for, I think, for UOB, I think UOB is, although price do rally and then close above, but we still have this resistance at 23.97, and then subsequent it will be at $24. So once it breaks this, then we can confirm the upside. But do take note that $25 may be another tough resistance to look out for. So if price goes around $25 to $25.06, then we'll be looking to exit the trend. All right. Then lastly, DBS, I think DBS, same thing. I think is forming like a head and shoulder. Look at the volume wise, I think we are looking at a head, and then there's a declining. So this is like 80% I would say is confirmed. confirm potential head and shoulder. So the neckline resistance will be like, if we break $25, then we can see that the next one we have a major correction. All right. And Sam Marine, I think Sam Marine, there's really not much. I think Sam Marine, other than the inverted head and shoulder, which I mentioned earlier, and I hit my target price one. Price subsequently do rebound, but if you look at that, I think we need to clear around 0.157. Reason is because this is like a corrective pattern in regards to the downside of the to the impulse outside of here. So if you look at that, we have three wave, and then one more third wave. So we might face some tough resistance at 0.167 and maybe at 0.170. All right. So for Mapletree Industrial Trust, I'm net short for this. First of all, I think price do recover, do have this long, I think, hammer over here. Then price fails to rally beyond $3, and then subsequently there's a decline. And then you look closer, this is really like a descending triangle, like this, like a descending triangle that is over here. So price may fall further, rebound, and then break below the support at 2.75. All right. The next one is SDI index I've done. Then I'll do KUO. Okay, so for international Siemens, yeah. So yeah, okay. So looking this like a pattern. So three way has completed. So but we will be facing some tough resistance at 0.7, and then subsequently at 0.074. So these this zone will actually be a huge turning point. So it's either you make it or break it going forward. So do take note of the levels. All right, and then GKE. Head and shoulder. Left shoulder has higher volume, followed by the head declining. So I won't look at it. So if you want to look at how the head and shoulder is going to end, if there is one, then we'll look at 1.382 is 116 to 0.11. And then subsequently over here at this major support zone between 0.097 to 0.101 for GKE. All right, you look at the Chimoku, I think price do goes up, but I think the lagging span is touching the candle. So we are going into a range for a moment. So I think we'll be going to the range before it breaks down for a correction. All right, but ultimately, I think you look overall, I think we have a tentatively uptrend for now. All right. So let me see the few more questions, and then TA for OCBC done. Ascenders. Okay, Ascenders. I think Ascenders I mentioned quite a couple of times that if price just need to be supported above $3.05, then we will see the maximum target at 3.26. All right. So but now my only concern is prices has been testing this support, this resistance turn support level at 3.05. So it might therefore weaken the support in this aspect. All right. So we still need to wait and see. We need to have a wait and see approach for that. Price do need to break above 3.18 to confirm further upside. But $3.30 and $3.26 will likely be the next resistance level. Okay. Okay, so I think they will be the last few. So before I pass to Terence for the capital ONM. Okay, so I think Wang Zijiang, Yang Zijiang. Okay, so Yangzijiang, I think it bounced off the support over here as $1 to 0.98. I'm still maintaining that the resistance that will be tested at 1.13 to 1.16, and then subsequently a correction, and then maybe it goes up. And then second scenario is it breaks off this resistance, and then just aiming for the next resistance at 1.34 to 1.38 going forward. Okay, so Landlease, I think Landlease is Landlease has been doing well in terms of the technicals. First of all, I think is right supported at 0.770, like what I mentioned, quite a few. I think the first webinar in 2021, I think someone asked regarding my report. So first of all, it's well supported. Then secondly, you make a U shape. So price and steady didn't go up. So I'm aiming for the next target price at 0.845 to 0.885. All right. So looking for it. All right, and then prices has been aging up. Look at the trend. Although trend has been up, I think just that the Senko Span B is flat for the moment, but if the bullish momentum still maintain, then the Senko Span B might turn up in the next few periods. All right. Okay, so I'll do MedTech for the last one. So MedTech resistance zone has been tested, rejected, and then come down. So this is like a double bottom, quote unquote. But I'm not very hopeful for this double bottom. So I think the price is going to be lower to 0.88 to 0.85 in the midterm. So there will be a rebound after that. So MedTech bullish momentum is not there. In fact, there's a mini head and shoulder going on for MedTech. All right. So with that, pass my time to Terence if he has any on Capital NM. All right. Thank you.
Okay, never mind. I'll take one question on the DBS. Yeah, let me see. Okay. Oh, sorry. Just give me a moment. Sorry, suddenly. Okay, your DBS target price is higher than pre-COVID last year. Do you think DBS profit will exceed pre-COVID? Okay, I think for valuation and for the banks itself, it is more on the asset quality. So because it is a price to book value. So as long as there's no credit deterioration and then they don't write off anything off their books, then that is when they will keep growing their book value. And as a result, our multiple will be 3.1 times of that book value, and it will, of course, it will continue to trend higher as long as there's no writing off. That's the main point. As long as there's no decreasing of their book value, that is when their target price should continue to go higher, because ultimately their assets in terms of their book will continue to grow and generate income for the future as well. Of course, when we if we take a look at when you will go back to pre-COVID-19 levels, definitely we are expecting at least 2022 before you start seeing some semblance of what it is to pre-COVID-19 levels. And in terms of earnings wise, definitely the last year, financial year 2020, their earnings is definitely beaten down because of the high credit costs. And this year, barring any unforeseen circumstances, we are also expecting the earnings to be a 6% higher than what it is observed in 2020 already, because of a lower credit cost, and like I mentioned, the fees growth will definitely offset some of the net interest pressure on the net interest income. Yep. I hope that answers your question. Not sure if Natalie want to take the CapitaLand CapitaLand question on current price. Not sure whether it's for TA or FA actually.
I think that's more of a TA question, but I'll take the question on FCT. So there's one question on FCT asking about here it is. Prices continue to drop since last week. Any reason for the outlook? I think that our outlook's relatively unchanged. If there is any reason at all for this decline in share price, it might be attributed to the possible exit of Metro Departmental Store from Singapore. So this will actually affect the Causeway Point asset within FCT's portfolio. And for FCT, this the exposure to Metro by NLA is about 4.2% on the portfolio level and 2.6% on the GRI level. Because as anchor or mini anchors within the mall, they take up a larger percentage of space. However, they are given a preferential rate, that means a lower rate because of this large take up in space. So as we know, suburban malls, especially such a strong mall as Causeway Point, which is located within Woodlands, these are sort of more sought after locations, especially with the rejuvenation or of the Woodlands area. So actually, this is not very much of a concern. Additionally, whenever a large piece of space it is divided up and sliced up and rented out to smaller tenants, this will actually result in a rental uplift for FCT. So the moral of the story here is that if Metro does leave, it might not be a bad thing because there might be some sort of rental uplift from slicing up the space and dividing it amongst other, releasing it out to other retailers. Secondly, of course, Causeway Point within Woodlands is a very central mall, as well as it's one of the larger malls within Woodlands, and is well positioned to actually capture and retain a lot of their tenants. So this might actually be an upside for FCT. So overall, that's my speculation. Other than that, I don't see any much change in the outlook. Yep, thanks.
Hi. Yeah, so maybe I'll answer the question on Keppel. There are two questions on Keppel. One from Ivan. Do you foresee any merger for Keppel O&M with SCM? Thank you. Yeah, so I think that has always been our thesis for that has always been our thesis for Keppel O&M to merge with SCM. We just don't see happening soon, but we do see there are advantages with there are several advantages with the merger between the O&M unit and the SCM. So for the benefit of those who may not be aware, you may recall that Keppel O&M, they actually split the unit into 3 units at the beginning of the year, into REITco and Development Co. So what they're going to do is it's likely that they will spin off REITco into SCM, but we just don't think they will do it now because of Sembcorp Marine having done a merger, a demerger from Sembcorp Industries last year. So they take their time and wait for the REITs to be more mature before they spin it off. Yeah. So the short answer is yes, but not in the near term. I think there's another question on Sembcorp. What is your view of Sembcorp Marine since the restructuring of Keppel Corp's O&M is almost charted out? Any potential of M&A which can boost its share price? So the short answer is yes. We again, our base case is we do think the spin-off, the REITco will likely be absorbed by the Sembcorp Marine unit, just not in the near term, because they will want the financials of Sembcorp Marine to be more stable first. So any given that it is not likely to happen soon, then we advise caution until there's more certainty. Yep, that's all from me. Thanks.
Okay, we'll just try to take the last 2 or 3 more. Okay, the question is outlook on Genting Singapore and the technical analysis of Genting Singapore. In just the outlook of Genting Singapore, again, we don't cover, not rated, but our own view is it will be challenging. I think even before pre-COVID, the gaming industry revenue for Singapore at least is actually very flat. It's a very mature industry, so this is not a high growth, and I think it's quite quite relevant when they mention the super VIP. Of course, they will never disclose how large is that to the overall revenue, but then they mention the super VIP will disappear. I think that's quite an important point to note. Until that they need to revamp the whole RWS 2.0. Not so much for COVID, but actually in fact due to this super VIP. So I think this industry in general should be very mature, and it will be remain big because I think I'm not sure how many people actually go to casinos this day. The form of gaming might change. So I think the outlook will be challenging. And do note that even pre-pandemic, Genting was trading about 92 cents. Now it's about 86 cents. So I think the market already pricing in quite a bit of the recovery. I mean, just purely on the share price. So that's my own view. Again, we don't cover. I think unless they win the bid in Japan and it's a good, but because Japan bid is quite heavily competed. There's many other bidders obviously, but or some have actually even left. But unless they win Japan, then maybe there could be a big jump in the share price. But it looks quite rich for now. Yeah. Okay, there's another question. There's another one. I think sharing the results briefing highlights is valuable, but can you also formalize like transcript? No, transcripts are a bit too much work for us to go and type it. Actually, the transcripts should actually come from the company, not from us. Yeah, like DBS provide transcripts. So it's very hard for us to type because we're already doing a lot of other results and a lot of other stuff. For us to provide the transcripts is going to be tough, but we just want to share with you because I know not many can get access. So we just share with you the key points. Transcripts, yeah, it's very challenging for us to go and we don't have the resources to do it. The other question is SIA equity attributable to company increased from 15.2 to 15.6 billion, even though they lost 142 million. How is it possible? Is it due to all hedging that has obtained in extra value? Can you estimate? Oh, okay, we don't cover SIA, but I think it's very difficult to estimate. I don't have the numbers, but it's definitely due to the hedging. They take some of their cash flow hedges through the reserves. That's all we can share. I didn't really go through in detail enough, but I think historically they always put their cash flow hedges through the attributable. So sorry, I'm not much value to share with you on that. Chehui, you want to comment on Yoma? Is there anything you want to comment on?
Okay, yeah, there's a question on Yoma. So the question is, can you comment on Yoma and is it likely to drop further due to political uncertainty? Okay, the situation in Myanmar kind of escalated, as in the situation in Myanmar escalated very quickly over the past week. Like peaceful protests became more rowdy, and then we have at least 2 people getting shot by the police and critically injured. The crowds actually defied overnight curfews to mass on the streets, and also police started to arrest people. So Washington last week imposed targeted sanctions against top military brass, and just today there were news about how there's near total internet shutdown, trains stopped working, and workers continue to go on strike. So as you can see, like the situation in Myanmar actually escalated very, very quickly from what was happening last week, where as in the week before, where the protests were actually quite peaceful. Yeah, and also the military is also looking to propose a cyber bill that will give military censorship powers, and also that will probably violate privacy and contravene some democratic norms and fundamental rights. So as in all in all, in like to put in a short answer, it's likely that it's likely that Yoma may see as in Yoma's stock price may actually see like further downside due to how fluid this situation is and this current train of events. And yeah, previously we actually had some hope that the political situation will improve. So we actually only factored in the reduction of selling price and currency impact. Going forward, it's likely that we will look to revise our forecast and target price again. Yeah, so we will keep you updated. This is all from me.
Yeah, just one quick one. Someone asked no updates on sets. Okay, sets we're most likely going to drop coverage. We just don't have the resources to cover, and we don't really think it's that interesting. Anyway, for sets, the aviation remains going to be a problematic. The only reason why you don't see like really horrible numbers is just that they're still getting a lot of government subsidy. So for this quarter, they actually managed to show a profit, but that's because they got 60 million of government relief. Just to give you, to share with you how much this government, SES makes about last year, pre-pandemic, they made about 180 million. This 9 months, government relief is 220 million. So all the numbers you see is kind of like, it's kind of shielded because there's so much government subsidy. So you don't really see the real pain on the numbers yet. So the irony is now that when things get better, the numbers might actually get worse if the things improve because they might be losing the subsidy. So I guess the one that we're watching a budget will be SES because they really need the continued government relief. But operationally, no change. I mean, with the borders closed, they do mention some improvement in cargo business, some improvement in restaurants. But again, without the airline moving, you're not going to make a big dent on the earnings. Like their flights handle or passengers handle is down 84%, 95% year on year. So it's still very, very weak out there. Yeah. Okay. Okay. Is there any other? Last one for me. Price of Asian pay TV seems dropping lately. What's the possible reason? Can this sustain? Yeah, the dividend yield, they've already guided they will maintain the 1 cent. So they definitely can sustain the yield, and because the cash flows are also getting better, they have enough cash flows to even de-gear. So that's our whole thing. But again, we'll see when they want to release the results. Yeah. Okay, the rest are all TAs. I think we can take it off for Weiren. It's up to you, Weiren, how much you want to.
Paul, I'm all right to take the last few questions. So I think I forgot to do some Fraser property. I think Fraser property right now is in a very tight range trading zone in response to a strong downtrend. First of all, I think if you look at here, I think you're likely to go into more correction. So likely to fall further to 1.10 before it goes off a rebound. In fact, I think if you look at this up move, right, recent up move, I think is in response as a very, very much corrective stance. So I think if price is going to break 1.10 and then followed by 1.06, I think the next one, I think we'll be seeing a much more stronger down move thereafter. All right, so I think the capital land, I foresee, I think a further sell down. From 3.1 now it's 3.14. So I think that I'm looking at $3 and then $2.94 exactly for a re-enter or to buy. So if you look here closely, we already have a let me close off everything. So we have rounding top at the resistance zone. Target tweezer top above key psychological $3.50 resistance level. Then we break down into the resistance over here, the neckline resistance. Okay, so price is going to correct further. So look out for support at $3.10 for capital land. So if price is really going to break there, then we'll be seeing more downside to $3 and then $2.90. That preferably that's the area that I will look at going forward. Okay, so how about if it gets rebound, then $3.30 may be which is the left shoulder. It may form a potential head and shoulder, and then this will be the neckline. Okay, all right. So yeah. So lastly, I think I do Thaibev before I end off the session. I think Thaibev last week has a three depth growth selling. So if price do not clear, I mean, do take note, if price do not clear the 50% and 61.8%, which is at 0.815 and 0.820 level, then we will be seeing like price may do further correction. So it's like a whole swing down. So you might want to take a look at Thaibev for this level that's above mentioned. All right, and then lastly, I'll do Genting. So Genting just now I've taken. So Genting, if you look at it, let's start from the RSI. So the RSI has done a double negative double bearish divergence. So you look from here and then we have the last one. So another interesting thing is ever since after sold one more and then it came down. This is like the double negative failure swing. So we expect price to go down already. In fact, this is like a double top, and then look at the volume wise. I think there's like less volume for buying already. So and then plus there's the resistance zone at 0.9 to 0.91. So price might look to correct further down to 0.75. And then if you look at that, I think this is like a wedge pattern that that is looking to break to pull back, break out, pull back, and then there's one more downside. So I think Genting not much movement for now. All right, so with that I end off my session. So before that I'll pass my time to Paul. Paul, do you have anything to add on?
No, but just want to thank everyone for your participation and your questions. Sorry, I know still there's a lot outstanding. You know, we really can't answer everything because there's too many, and some we actually don't have the answers. So we thank you everyone for attending and wish everyone a good year ahead and yeah, good health and prosperity.